Free use living on this channel for educational purposes only and is not intended as financial advice. It's Teaching Tech Tuesday. Let's discuss position sizing once again today. I'll go over some common position sizing techniques. The reality is we probably all use a variety of these techniques. This requires discipline. Obviously, this requires a trading journal to assess whether or not you're sizing things correctly and appropriately over time. So if you don't have that, definitely want to start doing that into 2025. And it's probably a great video to discuss trading journals for next week. But as far as the types of sizing, the most common would be a fixed dollar amount or a fixed percent of your account. So you say, I only want to risk $1,000 a trade, $100 a trade, whatever it is. A lot of people do that. Now that ignores the risk side of the equation. That ignores the reward. How well can this trade do? I don't know, right? If you can't answer that question, then it's probably not a great trade to begin with. And we're veering into gambling lottery ticket territory when you ignore any understanding of risk whatsoever. So as a qualifier to a fixed dollar amount trade, you always want to know what is your risk, and maybe your fixed dollar amount changes based on your risk. I'll talk about how to calculate that on the chart, but that's one issue with making those types of trades. For percent account trades, percent of your equity, NAV, however you want to think about that, this scales with your account up and down, but it does prevent sizing on higher conviction, and it also allows for drawdown risk once accounts get bigger. For example, alts yesterday were down 20%, right? So if you're still sizing an alt trade all the way up here based on the total percent of your account, that seems kind of silly. But this kind of talks to the sixth point here, which is market cap or liquidity based, which is, hey, maybe if I'm trading a sub-billion-dollar market cap coin, or I'm trading a pico cap, I don't size that at the same amount I would for any other trade. I size that way, way down. Maybe I think of those as leverage. Maybe I size leverage differently, right? And now we get very nitty gritty on what the individual does and what they're comfortable with. The fixed fractionals, what I'll talk about today specifically, you do need to understand technicals to a decent degree. You need to trust some sort of system. You need to have confidence in your analysis to understand what the risk is. Now, you can always just say, you know what? I don't care what the risk is. I'm going to use a fixed risk every time. I'm going to use a 2% stop loss on every trade, right? That is totally okay. And that's probably what you need to do when you're using fixed dollar amounts or fixed percent of your account amounts. But you still need to have some sort of system to understand in a non-random way, where should I be going long or short or in cash or in the market, right? Whether that's TA, sentiment, something else. You need something, right? You can't just have this non-random throwing spaghetti at the wall approach. Volatility based is similar to fixed fractional, and this would be if volatility drops way down, then we size things up. We size things up for two reasons. One, because we're confident in the technicals and the bias potentially of the market with something like Bollinger Bands or chart patterns. And we're also comfortable understanding that if this breaks our way, that there will be people trapped in longs or shorts who will have to cover those and push price higher, allowing for more bang for your buck effectively. But again, you need to know basics on TA, which hopefully everyone watching this video, listening to this channel, has leveled up on and has some confidence in, but that's also important. And then when it comes back to the trading journal and you're looking at, okay, cup and handle trades, these all work out, but I get stopped out halfway through. Or inverted head and shoulders trades, I see these all the time, they never work, okay? Or these cloud trades, they work great all of the time. I'm going to size those up differently. Knowing why you're taking a trade and understanding how that trade has worked out in the past is obviously no guarantee for the future, but this comes down to the individual once again, talking about sizing Kumo breakouts appropriately, sizing edge-to-edge reversals appropriately, even time frame. I mean, we can add that to this as well. If I'm trading on the hourly, based on some hourly chart pattern, I'm probably sizing that down. If I'm trading on the weekly, that's probably way up. I'm sizing that max, like max account or max appropriate account risk, because we know that trends on higher time frames, chart patterns on higher time frames, activity based on higher time frames generally has more conviction, has a higher hit rate than something you're trading on the 1 second chart. And then, like I said, with the low liquidity, micro cap, whatever, you can use TA on that stuff on any time frame. But, if you're just buying something because, hey, it just got listed, et cetera, et cetera, et cetera, and you don't have some system for that, you're probably going to lose 99% plus of your money. You're only hearing about the people who actually made money, right? Survivorship bias. You're not hearing about the people who have lost everything on Deck Screener trying to pick some microcap. Now, if you were truly highly disciplined, you could do all of this at once and then figure out what works best for you in what situation. But when I'm thinking about the BTC breakout pre-post election, when I'm thinking about ETF stuff around BTC, when I'm thinking about the Square move on the weekly, the gold move on the monthly, right? Those trades probably need different risk sizing. They probably need different understanding of what is the likelihood that these actually play out, right? Again, if I'm trading on some ultra low time frame 4-hour inverted head and shoulders, I'm probably not sizing that up the same as I'm sizing up a multi-month breakout potentially. So if we look at the risk reward profile on your chart, which I'll show on Kraken in a second, what we can do is measure the risk reward. But obviously you need to understand, again, what is exit, entry, stop loss. If you can't do that, then you cannot calculate your risk reward. And if you cannot calculate your risk reward, you probably shouldn't take the trade. Now you might just say, well, I'm a trend follower. I like breakouts of the cloud. That's fine. But you still need to be able to calculate some exit somewhere. Ideally, there's something you can measure always with the fibs. And this kind of marries a bunch of concepts together to allow you to get to the point where you're using this with conviction and or sizing this appropriately. But let's say we know historically that a risk reward of 6 or a risk reward of 5+ or whatever it is for you. Again, this comes back to the journal. When you're looking at this stuff over time, am I a better trend follower? Am I a better chart pattern trader? Am I better on lower time frames? Am I better with a risk reward of 3+ versus 2+, and then sizing that appropriately from there? But let's just say we come up with a fresh system. We say, hey, if there's a risk reward below 2, I don't want to take that trade. And let's say our account size is 10 grand or whatever it is. Then we can calculate sizing relative to the risk reward profile. Before I go any further here, let me mention today's video sponsor, Kraken Pro. And Kraken Pro is the complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PBI, DBA, Kraken. Looking at the chart today, everything's been all over the place, right? And the best trade, here's the hardest part about trading. It's people don't have the conviction or the system to take the trades before the move happens. They wait too long and or see the move happening and do nothing. And then by the time price is where it is now with whatever, they FOMO in, lose everything, and then do it all over again, not understanding what went wrong, right? So you need to have some sort of system. Non-random, again, it doesn't matter what it is. Throwing chicken bones on your desk and reading the tea leaves, whatever it is, that's okay. But ideally, you are dialing that in over time and figuring out what works and what doesn't. So we take this back to pre-election and we look at this breakout and we're a trend follower. We like the cloud, we like whatever, et cetera, et cetera, et cetera. One great way to always measure what a target would be for anything is the fibs. And you always see me measuring with the fibs all the time. For measurements higher, we take the high and the low of the range. Usually for crypto, I cut off the wicks completely. Usually. Again, this is up to you. But if you want to just eliminate all the variables, put this on like the line chart. That way you're not looking at wicks ever. And you're only looking at candle bodies. But I would try to be consistent with it. So like I was saying for a couple weeks now, right? This was the target. This is the price target for the previous consolidation. Beyond this for BTC, it's hard to measure anything, right? The other thing people do is they make this great slam dunk trade and then they just assume that they're invincible or godlike and they could just keep trading and trading and trading. That's generally not how things work. You want the market to come to you. If you waited for this for 6 months, ideally, this is a trade that made your entire year, right? Just as this trade was, this trade was back here from 40 to 70. I mean, my two best trades this year were 40 to 68 or whatever that was. And then this breakout trade here, 60, 65 to wherever we are today. You catch those, is there really anything else you need? When you size those appropriately, those are massive trades, massive trades. So if you had recognized pre-breakout the potential of what could happen here, even if you just measured this and you said two things. You said, okay, this could be some sort of complex head and shoulders. I'm going to use this high and this low. Let's just delete all this. We're going to use this high, this low, use the fibs, give us a target. Again, we're trying to like precisely cut the wicks off. This is the chart pattern. It's not perfect. It's messy. We know what could happen. It's a diagonal neckline. It's not textbook, right? We can go on and on and on. We can look at the volume. We can say, hey, is the volume profile perfect? No, not really, you know, but add that to the journal. Hey, if you like a chart pattern, you say, I know this is a mess, or whatever you want to diagnose this as, and say, this is not a perfect pattern, but I like it for XYZ reason, or whatever, right? What you'll probably come to find out is things that are a mess, or things that look kind of similar to something else, if you really squint your eyes, are most of the time good enough. But anyway, so let's say we get this. This is our risk reward setup here. Our entry is the breakout. Our stop loss is the bottom of the right shoulder. We go to the long position trade here. We're going to go max. If you want the 1618, you can. We're going to go max. So this was a 5. And then we size that appropriately. Even if we just caught this, that's a great trade, right? So for most charts up here, to me, I don't see anything up here just yet, to me. You know, we can go on low time frames, and I don't have good things to say about BTC or about ETH on low time frames. I think the most troubling thing right now for BTC is the potential of this inverted Adam and Eve. You get a V and a U. The opposite of that is a V and a U. Basically a double top type fractal. This ignores everything that isn't exactly on this chart. This ignores cycle, it ignores everything. Sailor, NASDAQ, QQQ, you know, you can just hit me with endless things that are coming. I'm not going to disagree with any of that. This is not looking at any of that. This is just looking at what we have in front of us. So if we were to measure this with fibs, again, you have to be comfortable, A, recognizing the pattern, B, knowing where to measure, C, you know, do I measure at the depth here, the height here? Do I use a bunch of measurements? You have to be comfortable doing all that, obviously. It's on a lower time frame, so do I size it down from there? But these are all questions that ideally you're identifying for yourself over time. So we've got this set up. It has an R&R of roughly 1.5. I mean, really, we could probably move this up to above the cloud. And this is another thing you don't want to do. You know, let's get this into my wheelhouse of trading, because I want to take a trade, right? You got to be honest. Again, you got to have conviction in your system. But let's just say the profile is something like this for this short, and it's counter trend, and all the other things we know about Bitcoin in December, etc. Whatever. You know, you size that appropriately. We go back to the sheet. It's sub 2. Do we want to take that trade? Maybe we do. Maybe we don't. Let's say we did. Yeah, we'd size it down. This is our account size. This is our mathematical size that we want to take. Or you could just simplify this and say the percentage of my account based on the risk reward. So 2 is 2%, 6 is 6%, or whatever, right? Again, it doesn't matter what it is, as long as it's something that is verifiable, and you can go back in the future and say, hey, this works for me. I can sleep at night. I'm comfortable with this kind of sizing. So the sizing conversation is difficult because it's very personal. You know, do you want to size this down because it's the 4 hour? Do you want to size this down because it's counter trend? Do you want to size this down because you're not good at shorting and picking up on shorts generally, right? So this is one way to skin this cat. So in summary, you'll probably find that the best way to successfully size your trades is understanding the risk of your trades. And if you're just randomly guessing, it's probably difficult to remain profitable over an extended period of time. So the first step is always having a system that you can identify risk and reward, having some sort of understanding of technicals here, and then going from there. And you can always allocate different strategies and say, hey, this is my DCA hold until April 2025 bucket. This is my trend following bucket. This is my chart pattern bucket. This is my microcap bucket. That may be more difficult to manage, admittedly, but for some people, they will find that that is highly successful for them. One other setup I'll mention that I like here because it is atypical for me to say I like Ethereum to the long side. But if we go to a high time frame and you're speccing out, ETH on the weekly, right? What is a reasonable stop loss here for ETH to the long side on the weekly? Let's say theoretically we get some sort of average around 38 or so, whatever. Where is an appropriate stop loss here? Now, I don't have a great answer for that myself, right? Maybe we just say the weekly cloud and that's that. You want to make this sort of obvious and instant. We don't want to get below the weekly cloud, which is 3K. So it's a nice round number. We'll just say 3K. From there, again, we'll use the fibs. We're measuring from high to low. And whether or not this target actually happens is something else. But if we really think the risk reward here is 15, then we better size that appropriately. Otherwise, what are we doing, right? And this, again, goes back to the individual. If your account size is 10,000 and you're risking $1 on a trade that you think looks like this, it's going to be difficult to do well over time because you aren't making a lot of money on the upside. So if you think ETH could go to 10, 15, whatever, right? Maybe that's a great buy and hold bucket idea, where you say 3K is my stop loss and that's that. We could also measure this probably more reasonably for the near term. And maybe this would be a leveraged trading idea where we say on the daily, this could morph into a potential cup and handle a potential, inverted head and shoulders here. It would look really clean. It would look pretty textbook. And what would our stop loss be? Potentially, again, we'll call it 3,000. And we measure that. This gives us a risk reward of 4. So we go back to our trusty cheat sheet of percentages and whatever else, and then go from there. And as a leverage trading idea at the breakout into 2025, maybe that's how we size this appropriately and get ready for this. But a lot of this is just analysis and preparation. And it's less about, hey, they just listed this coin. Let's go max account long. That's all I have for this one today. Like, dislike, comment, share, subscribe.